Well, good morning, everyone. This is Michael DeVille coming to you from beautiful Phoenix, Arizona, here in Maricopa County, probably the #1 real estate market in the United States. We're here in the super plush studios of West USA, and Tatum and I are doing another Creating Real Estate Wealth webinar. It's live, and of course, if you look onto your screen, if we have a chance to answer the questions that come in, you're welcome to type them in. Tatum will go ahead and monitor that for you. I'm going to try and be very respectful of your time. Should take about 21 minutes to go through this, unless I get talkative on a subject. You know, I love these subjects. This is just a great subject. I do want to tell you that we get questions during the week, and oftentimes I answer those questions on the Saturday podcast. And if you go to the internet, you can go and just type in West USA Realty Podcast, and a couple options will come up. It's even on Apple, and you're welcome to watch the podcast. And we'll often review what we've talked about on Tuesday and review some of the questions. If the questions come in, we'll certainly try and answer them. So I want to thank West USA for giving me this platform. The real estate business has absolutely been wonderful for my family and I. You know, I'm the author of How to Create a Real Estate Money Machine and Retire with Income. I cannot stress this enough, that retirement is strictly a financial decision. It has nothing to do with age. It's my desire to create a real estate money machine that's going to give income to you and your spouse and your kids and your grandkids for decades, possibly generations, and it's just going to continue to increase your life and make it so much better. And of course, that's our mission. Now, we're going to talk about cash flow next week. Cash flow, of course, is one of the great indicators for me. If we're not going to get cash flow, you have to ask yourself, what are we buying this property for if I'm not going to make any money on it? So we stopped doing that. So we're going to talk about the cash flow indicators. That is next week. And the indicator, when we do our calculations, is going to tell you how good a deal you got. So it's a key indicator of how we're getting rich. That is next Tuesday. And we're more than happy to discuss anything in between. But today's topic is we're going to talk about long-term loans, and we're going to talk about leverage. Now, I know a lot of my competitors and a lot of the other advisors have talked about when you buy a piece of property as a rental that you should pay cash for the property. Paying cash for a real estate investment certainly mitigates risk. And you get a really big cash flow out of it because we're not doing any debt servicing with that investment. However, it's very, very difficult with which to build an exposure to real estate if you're doing only cash. Now, as a baby boomer, we've had the ability of a lifetime of accumulating capital. And oftentimes, as baby boomers, we buy a lot of properties cash because we're really interested in getting the income streams on a lot of these properties, which is what, it's a very, very conservative and consistent monthly income that we get. And this is very, very important. When you're still younger in your life, you still want to get some real estate exposure. And even if you're older in your life, if you're just starting out, you really should have real estate exposure in it anyway, particularly in this section of the cycle that we're in. I know there's some concerns about the economy. There's some concerns about what's going to happen. I'm going to tell you that I've been through many, many recessions before. This is very, very typical, and it's a buying opportunity for you. We are going right into the accumulation phase, and this is really the type of marketplace that you want to start accumulating properties, because right behind the accumulation phase, we get the explosive phase, and that's where your portfolio really takes off, and that's really where you make some money. So it almost forces you to go in to get some leverage. Now, leverage is a two-sided sword. Now, if you recall in 2005, if you were around in 2005, what a wonderful market that was. 2005, the properties here across Maricopa County went up 54% in 1 year. Now, that was the explosive phase coming in, 54% 1 year. That's a really nice return for that. However, a lot of people over leveraged, and it wasn't the real estate that caused them problems. It was the loans that they had on the property. And we're going to talk about how much of a loan you should put on there. And that's part of this segment. So other question, okay, how should you leverage the acquisition of an investment property? How does leverage supercharge my cash flow? Oh my Lord, how does that super cash it? It's going to really supercharge it. We'll talk about that. And is there ever a time to refinance or cash out the property? We're going to talk about the couple times that it would be worthwhile doing. So let's just talk about long-term leverage. Why should you lever the acquisition of an investment property? First off, one of the only times that you want debt is on an investment property that's paying for that debt. I'm not a big proponent of having personal debt. So that means your house should be paid off, your credit cards should be paid off, your car should be paid off, and you should have reserves in the bank. Investment debt is investment debt, and the investment debt is to make you money. If you're making money, then you can go into debt for that. And of course, we never want to take so much leverage on a property that we're ever going to jeopardize our portfolio or jeopardize the asset itself. And here in America, if you're just starting out, we have loans for virtually everybody. The one requirement that is most important is for you to have good credit. If you have good credit, then you can work a program that you can get a loan. If you don't have good credit, shame on you. No excuse for bad credit. If you have bad credit, then you need to get onto some kind of a program to get good credit. If you're not paying your bills, start paying your bills. Talk to a lender to get yourself good credit so that you can get onto the train. The real estate train is going to be leaving the station, and you need to be on that train. So when we talk about leverage, we have two different. We're going to talk about a seminar this Thursday. By the way, the seminar on Thursday is sold out. We don't have any more room for that. If you want to get involved on the next, want to register for the next seminar, you may want to do that. But we are sold out for that. We're going to be talking about at the next seminar doing exactly getting into properties for little or no money down. And we're going to talk about when to do that. But why should you leverage the acquisition of investment? It gives you more exposure. So if you have 100% to put down on a property and you want to put 20% down, you can buy 5 properties for the same 100%. And that is called opium, other people's money. Now we have calculations, we have formulas to make sure that we never jeopardize the asset. But in markets like we have right now, you certainly want to have real estate exposure. And in the United States, we are so blessed here with having long-term 30-year fixed rate mortgages at these rates. We are at historically low rates. How can you not be getting these mortgages? You know, in Europe, they don't know what a 30-year fixed rate is. This is some kind of a new concept for them. Here in the United States, we've had it for 50 years. You could get a 30-year fixed rate mortgage, and it fixes that rate forever. You know what the component you're going to be paying on that payment is always the same for the life of the loan. If you take out a fixed rate mortgage for 20% down, in 30 years, it's going to go up 5 times. You put 20% down, you get 100% back. So if you put $20,000 down on a $100,000 property, you're going to get $80,000 back built into the loan. So you automatically know that whatever property you buy, you're going to get 4 times your money back because someone else is paying this off. What a great advantage is that? And it's fixed rate. So I want to tell you, we're at 5,000-year lows. The odds of us going negative are pretty nominal. Now, I know that they are a little bit in Europe. I don't know that we're going to do it here, but we're so close. You can get a 4% for an investor loan and owner occupied somewhere in the mid 2s. Could we go down to 1? Maybe. But at this juncture, you should be fixed rating these. I would not take an adjustable rate mortgage because the odds of it going up are so much higher than it going down. So why would you take a chance when you have these wonderful rates? Fixed rate these mortgages. Do not take an adjustable rate mortgage. So I'm going to jump here to number 3. Is there ever a time to refinance a property? Yes. There's never a time to take money out of your property and go buy a toy, go buy a motorhome, go get this big sound machine. I'm going to go buy a rock crawler. Never, ever is there a time to take money out of your investment and go throw it away on a toy. That is investment money. Now, there will come a time in your life when you can have anything that you possibly want. You just need to sacrifice for about 7 to 10 years. After that, your investments are going to start sending you cash flow and cash flow and cash flow. And you can spend the cash flow, but you cannot spend the capital. So that's the rule. I can spend the cash flow. I cannot spend the capital. And if you refinance, take money out of an investment, you are spending the capital that's within there. That is absolutely never, ever allowed. Oh, when can I refinance? Well, if you have mortgages, you have to do the formulas. You're welcome to come in and see me. We can sit down and brainstorm. Is this a good deal or not a good deal? Now, if you're doing a simple interest rate reduction, and we're going to pay it off in a reasonable amount of time, because keep in mind, when you refinance, there are costs. You can't do this for free. So we have to make sure that when we get the delta, which is the difference between what I was paying and what I'm going to be paying, that savings, that delta is strong enough to make sure that it's worthwhile doing. If it's worthwhile doing, you will have my blessing, and we'll go ahead and do the rate reduction and move on. If not, we want to pay these mortgages off. So if you're down to like 15 years left, we need to take a really hard look at this, and maybe we want to accelerate the principal reduction and pay the property off rather than take more money out. Which leads me right into the question, what if we've got a property that we've owned for 20 or 25 years? The depreciation is probably pretty close to being out. If we bought it for $100,000 20 years ago, it's probably $450,000 now. So we've made a lot of money on this property, and we're sitting with maybe we have $350,000 or $400,000 in equity in the property. Now, we may not want to, maybe we've got a long-term tenant in there, it's raising their family, so we don't want to disturb the sale, but we do want to increase our exposure to real estate. Well, that would be a perfect opportunity for you to take money out of the property and purchase another investment so that you can get some more depreciation, get some more cash flow, get some more principal reduction, and enhance your portfolio. This would make perfect sense to do that and make more money. And you keep in mind, you're going to get more and more cash flow. You can spend the cash flow. You cannot spend the capital that comes out of that. We would, of course, eventually get to the point where we want to restart the depreciation on the property. If you've had it for 27 and a half years, we're pretty much over with, and that would be a reason we'd want to sell that. Whenever we're going to make a financial transaction, whether it's you or one of your clients, one of the questions we need to ask, what are we going to do with the money? If you don't know what you're going to do with the money, why are you doing this? You need to have a plan. So if we're going to take $300,000 out of our property, what are we going to do with that $300,000? And if it's to buy something and enhance our portfolio, I'm all for it. You're welcome to come in. We will sit down and do the calculations. And once you've done them, you won't need me anymore because you can do them yourself. So you're welcome to do that. So let me just go back down to number 2. How does leverage supercharge my cash flow? I love this. This is just great. Leverage is wonderful if it's done absolutely properly. So here in Phoenix, it's almost impossible for us to have a property that's not going to give us $1,200, $1,300 a month cash flow after we've paid the management company, after we've paid for the vacancy factor, after we paid for cost of sales, after we've done a repair escrow, after we've paid for landscaping and pool repair and pool service, principal, taxes, insurance, and this is going to give us a cash flow of around $1,200, $1,300. That tells you what the property is generating on a return. You can then make that decision if I'm going to take $1,000, $1,100 of that, and spend it on debt service and put some mortgage on, put some leverage on, and say of the $1,200 or $1,300 I'm going to get, I'm going to spend $1,000 in leverage and put a mortgage on. So you're probably getting $300 a month. I just raised rents $150 a month, and I raised rents $250 on the properties that just came up just recently. And here we are in Maricopa County, the best market in the United States, and rents are going up. We have a shortage of homes, and this is causing our rents to go up. Now, if I raise rents $100 a month and I'm getting $200 a month cash flow, because remember, I'm spending out of that $1,200, I'm spending $1,000 of that for principal or for debt service. That means I'm only cash flowing a couple $100 net to myself, free cash flow. But we have rental increases virtually every year here. So if I'm getting $200 a month and I raise it $100 a month and I'm leveraged, what is the percentage increase to me in my cash flow? 200 and 100, I'm raising my cash flow by 50%. So now instead of getting $200 a month, I'm going to get $300 a month or more. So it supercharges your returns on your cash flow every time we raise the rent, and that's virtually every single year. And some of this has been really radical. And keep in mind that Maricopa County is cheap on rent compared to the rest of the country. Our rents are cheap here, and we have a huge amount yet to go. There's a potential for much higher prices, much higher rents. This is so good for you. So I'm going to try and be very cognizant of your time. We've got another 3 or 4 minutes here. I want to talk to you a little bit about cash flow for next week. Cash flow, of course, is the indicator. When you buy a property, we try and get these properties free and clear, and we want to get that cash flow coming down so that you can live on that cash flow. That's how we're going to get you retired or semi-retired. Oftentimes, look, I'm going to tell you, at 40 years old, you may not want to fully retire because at 40 years old, all your friends are still working. There's no one to play with. I mean, you and your wife can go out and your spouse can go out and have some fun, but most of your friends are still working. So you may want to work, but go find something that you really enjoy. Maybe you can become a CE teacher or teach one of these classes where you get some fun. So that's our cash flow for next week. So I want to tell you that don't miss that one. And I want to tell you that if you have any questions or comments, you're welcome to email us here at creatingwealth@westusa.com. We're going to have more seminars coming up. We are full for Thursday. I actually have a waiting list for Thursday. We cannot accommodate anymore. We've had a huge outpouring of people that want to come. We can't do any more, but we're going to do more. We have a whole series that is going to be coming in the way of financial topics. We're going to be doing CE classes. We're going to be doing a designation. If you want to register, send an email to creatingwealth@westusa.com. If you have any questions, send it to creatingwealth@westusa.com. And part of my give back to you guys, I am more than happy to sit down with you each and every week and maybe go over some topics. Maybe you have some questions. If you want to go over, if you have a property that you want to look at, you're welcome to call me. You can call me at the corporate 602-942-4200. If you find that you really need to talk to me or you need to contact me, you're welcome to contact me at michael@michaeldeville.com. So I'm going to be trying to be very cognizant of your time. It's been about 19 minutes. I want to thank you so very much for listening to me. And I want to wish you the very best. You're in the best market in the United States. Have a great day. Bye-bye now.